You could be in business, you could be an originator, and you could trip over success. Now our jobs are really, really difficult as LOs.
Hello, friends. Welcome back to Market Shares. I'm your host, Tony Blodgett, and today I have an awesome guest on the show today. Actually, a second-time guest, my friend Ryan Hills. Welcome back to Market Shares, buddy.
All good, man. I'm so happy to be here, and anytime I can jump on a call with you and talk about the industry, whether it's being recorded or not, I'm down.
Yeah, well, you know, I find that every time we hop on the phone to just have a quick catch up or something, it ends up being a much longer conversation than we expected. So I'm not going to be surprised, you guys, if this ends up being a couple episodes. We'll see how the conversation goes, but there's lots to talk about. And, you know, I just mentioned in one of my last episodes about the importance of relationships. And I mentioned getting to know people in our industry. And Ryan is one of these guys who is technically a competitor of mine. We're in the same market. We have similar roles in our organizations, and yet, you know, we're good friends. And I know there's been, you know, business that's gone back and forth, recruits that have gone back and forth. But at the end of the day, you know, our friendship is, you know, above all of that. And I think that it's a perfect example of what I was talking about the other day. Is you have to have these kind of relationships, and the things that we're going through in our industry right now, and the things that Ryan and I are going to talk about today are the exact reasons why you have to have these kind of relationships. So Ryan, I value the fact that we can elevate our friendship above, you know, the dealings and going ons within the industry, and be able to always connect, and at the same time recognize that there's certain things that we don't talk about because we work for competing companies, right, in similar markets. So
Yeah, I mean, I've said this before, man, and I'll say it again. I think I'm a better leader because of my relationship with you. And I hope other people can say the same thing about me. And we have several other peers. I think we're going to California here shortly to spend time with them. And they all have similar roles. And technically, we're all competitors. But I find it interesting, Tony, you and I were talking about in the green room, how some of these younger originators don't have that same mindset or desire to have deeper relationships. I'm glad you're talking about that. Because again, I've learned so much from just masterminding with you, picking your brain, and I'm better because of it. And I can't wait for times like California, where we get to come together and spend a few days together, talk about what's working, what's not, you know, mastermind some new ideas. So if you're a young originator, you know, follow Tony's lead on that, guys. Like, seek out other relationships. I don't know why the industry makes you feel bad about having a relationship with somebody that's at a competitor. We're all in the same industry. None of us have more than a few % market share, guys. It's fine. There's enough to go around. You know, seek out good relationships. I promise you're going to find out what Tony and I have already figured out, that it makes you a better competitor, a better leader, just all around a better performer. So there's my 2 cents, adding on your previous content that you talked about, just, you know, pursuing deeper relationships.
yeah, absolutely. Well, and more so just the relationships. It's also the involvement in the industry. And I know I wasn't going to lead off with this topic, but I do think that, I don't know what it was about 20 years ago or 25 years ago when I got in the industry, people seemed like they were really involved in the industry. I mean, I've been going to the Washington Mortgage Bankers Association meetings for 25 years. I've been on the board now for close to 10 years. I feel like that sort of industry involvement is important. And I don't know what's happened over the last, you know, decade or so, where it just seems like both on the mortgage side, but also on the real estate side, people just don't seem as involved in their industry. And, you know, it's gonna play itself out at some point as our industry, you know, no one's there to fight for the things that we feel are important. And we're going to talk about that here at the end of this conversation about, you know, where does this industry end up? And I promise you, it's not going to end up where you want it to if you're not involved in the industry as it's changing.
Yeah, I mean, if you saw Housing Wire just today, they talked about how NAR, the MBA, who you just referenced, and the Builders Association all collectively petitioned the Fed to, hey, stop it. You know, you're hurting the industry, you're hurting affordability. To Tony's point, if we just let these advocates die, who is out there fighting for us, fighting for our borrowers? So I know it may feel like you don't know why there's a NAR or an MBA, but I promise you there is. And the more that you are engaged, the more you realize how much they have done for us in the past and are still doing for us. We need more attendance, guys. We need more youthful leadership in there. I'm the old dog now, and there needs to be the younger version of Tony and the younger version of Ryan there.
How did we become the old dogs? I don't know how that happens, but it does.
Still feel young, but yeah.
Well, you look old. But anyway. Anyways, well, before we get into this, just for those that don't know Ryan Hills, maybe just give a quick intro, because I'm going to reference to your show every Monday for the last 15 years. You've been doing the resource.tv is your channel, and you do a fantastic job. I would say one of the OGs in the mortgage, content space. I still watch your episodes every single week, and I'm going to reference back to a few of those, but maybe just give a quick background on who you are, a little bit about that show, and then I'm going to jump into a couple episodes that I'd like us to dig a little bit deeper into, kind of what's behind those.
Yeah, I appreciate your support, man, with the resource all these years. It means a lot to me. It's funny, when I travel a lot, I'll meet people that they know me through the resource, or the other one that's kind of funny is our other buddy, Ken Perry. They think I work at Knowledge Group. Only
because you're in the CE, yeah.
Yeah, because I'm in the CE. They're like, a lot of that. It's like, oh, how's Ken doing? And the how's business? I'm like, he's doing good, but they think I'm actually part of the Knowledge Group. And I tell them, like, no, I'm actually in the business. I run a really big region for Movement Mortgage. It's about a $4 billion region that runs most of the West Coast, and humbled and excited to work with some of the best people I think that are in the industry. So that's where Tony and I get to connect real deep, like just running really good regions and being a good operator, being a good steward. Those discussions have become way more paramount, in my opinion, than the last 2020 and 21. You could pretty much do anything and win. And I'm not saying, no offense to anybody, like we still had to work hard through those years, but you could be in business, you could be an originator, and you could trip over success. Now our jobs are really, really difficult as LOs, regionals, as companies. And for me, like, I get excited about it, like, okay, let's go. And I'm not sure that all of our peers are going to make it through as much as I want them to. And I'm sure we'll talk about that later, but those are the conversations that I think Tony and I unite on and get excited about. Like, oh, things are getting tough. Like, the cream of the crop is going to rise to the top.
Yeah, no, 100%. Well, look, I love your show. I think that, for me, I started developing content a lot because, of the great job that you did. And then here you are, you turn around and you up your game even higher. I mean, your last, however many, months or years of content is just, I think, some of the best in the industry. You've done a really good job of identifying things that are important to people. And after 15 years, I think, if you're not watching the RE source or you haven't subscribed, you should, because that's the stuff that people are talking about. And you do a great job every single week of doing that. But one of the episodes that you brought up a few months ago was, and here we are, we all thought that this market would turn around. I mean, gosh, at the end of 22, everyone thought, well, by spring of next year, this is going to be better. I mean, 22 was a shifting year, really by the end of the first quarter, we could see rates had already started going up significantly. We didn't think it would last forever. That's everyone's answer, right? Oh, the end of the first quarter next year, we should be good. March comes, April comes, there was predictions that interest rates would get a lot better by April, by May for sure. I'm not even going to talk about May 10th, but we all thought that there would be some reprieve here. And then I don't know when you put out this episode, but it was after May, I believe. It was probably May or June. And you said, what if we're only in the third inning of this whole mortgage situation? And I think at the time, everybody was like, that's crazy. Like, we're in overtime right now. I mean, this should be over by now. And you're like, maybe we're only in the third inning. That, I think, is, it aged well, because here we are in October heading into, we're in the fourth quarter, and I don't know, man, I think you might've been right that maybe we were only in the third inning. What brought about that idea for that show? And then where do you think we're at right now?
Yeah, I think this kind of ties in the fact that I'm, like I said earlier, people don't know that I'm still in the business. I think I just do content or work for Ken, but I have to make these tough decisions like you do, Tony, like every day. Like, do we need to continue shrinking staff, full-time employees? Should we look at our leases? Where should we set our margins? How do we preserve everybody through one of the most difficult times we've ever seen? Should we preserve everyone? Should we, like all of these really difficult conversations I'm having to make at a large scale every single day, just like you and a lot of the people that watch your show. So for me, I started thinking like, what if we aren't on the backside of this? Like we hoped that May 10th was, we talked about May 10th. May 10th was going to be the end of, that would have been in the ninth inning. That would have been the end. And we're on our way back up 5%, rates. And that came and went. And so I was like, I think a lot of the behaviors, a lot of the decisions that we should have made as good operators in the business were delayed because of this hope of May 10th. And if May 10th is not going to come, it's going to be Q3 and it's Q4 and now it's Q1 next year. And I'm like, how do I get myself and my leaders in the industry to change their perspective of continuing to hold off tough conversations? And so I just thought, well, I wonder if they all knew that, if we had this crystal ball and we could look in the future and see that we're actually in the third quarter of this game, how much would their decision making change? And to me, I was like, well, massively. They would stop holding off on these tough conversations, right sizing team size, right sizing the staffing. And I think it would change overnight. And so I kind of ran with this idea, like, well, I wonder if we are in the third quarter. And to your point, thank you for pointing out the fact that we've dug in with more graphs and charts and stuff. So I really started looking at it going, I think, I don't know if it's the third or fourth inning. That's not really important, but I do believe heavily that we're probably not close to the backside of this. And you're right, that was like May, June, but it looks like no real rate reprieve until June of next year. And it's not a massive one either. It's a little one. It might even be the start of a reprieve. So that kind of lends credibility to the thought of maybe we were only in the third inning back then. And I didn't necessarily get hate mail, but my own CEO, all he sent was like a throw up emoji. That was it. No other context. Just like, please tell me no. And for that first week or two or three a month, it was a little bit of like making fun of Hills and the Ari source. And then again, to your point, now people have come around like, dang, dude, he might have been right. He might have been right. And it wasn't, I had already learned my lesson from our good friend, Barry, of be careful what you predict. And he had really good math, guys. Oh. And so everybody's giving him a tough time for that prediction. I understand why, but he didn't just throw a dart. He had really good math to why that should have happened. But I had already learned that lesson of making predictions. So it wasn't about me making a prediction of when this was going to be over. It was about just getting in that mindset that we have to make tough decisions now, hoping that things would get easier sooner. So it wasn't so much about the prediction, although to your point, it might be right.
Well, and I think my biggest takeaway from it, and we might have even spoken on the phone around that time, is we all need to be acting as if, right? As if it could only be the third inning of this. What would we be doing differently? And I think that's kind of to your point, and that's the way I took it. But turns out, I think we may have only been in the third inning. Let's talk about the impacts of that, though, on the industry as a whole, right? Because, we know what the impact is for loan officers. I mean, it's been very, very difficult for loan officers to feel that shift in not only interest rates going up, but and refinance business as a result going away. So there's a big percentage of your business is gone. Now we have really low inventory issues, and we start bumping up against some serious affordability issues for borrowers. And all those things create like the perfect storm for loan officers. And I think that's, I don't know, I want to say the obvious one, but we know what the impact has been for loan officers. But there's other people involved here. And I want to talk a little bit about the impact to organizations, to companies and how they're dealing with this. One of the things that I'm super grateful for, and I'm sure you are too, is just being in a time like this and working for an organization that's the size of the organization that you and I both work for. And not just the size, but the way in which we do business. We service all of our loans. We have that hedge against the production with the servicing revenue coming in. Or let's talk a little bit about, who else is being potentially impacted by this dragging on and on and on. The first thing that comes to mind for me, obviously, is both small and large companies that don't have that servicing revenue stream coming in. Unless they have some other stream of revenue coming in, most people aren't making money on the origination side of their business. And if that's all that you have, that's got to make it extremely difficult, I would think.
You got a short runway, and you better have a lot of capital and be okay burning it if you don't have servicing income right now. And I guess that makes the conversation about what inning we're in a little bit more important if you're the owner holding the bag, right? Like, okay, what was the last, I don't even know, Tony, you might know, but the last time I looked at it, we were losing $1,000 per loan as an industry. And again, having a little bit bigger scale, servicing, having owners that save money through the good times makes us feel good that it's tough, but we're going to make it through. But imagine if you were a smaller company that didn't have servicing. Most companies, if they're profitable, if they're making money, it's only because, as Tony said, the forward side of the business is losing money and the servicing income is buoying the company right now and helping. If you don't have that, you're left with closing loans at a loss. And I'm a fiscal conservative guy. I don't know how much, I'm trying to be honest, like I don't know how much I would do that as an owner. Like how many months do you run at that rate and hope that things get better? Is it going to be Q1 next year? Is it going to be Q2 next year? You're probably starting to look at your balance sheet going, well, better be soon because I'm getting thin here. So that's what I find interesting. And I came from a small company too. And so there's a special place in my heart for that. One of my favorite books is called Small is Beautiful. You ran a small company. So when I say this, it's not because I want small companies to go away. I'm just not sure how they navigate this without servicing income, without a ton of capital to kind of burn through. So then if not, what happens to the industry? Do we all work for 4 or 5 companies at the end of this? Like, I'm sure it's not that bad, but that's what I want to know too, is how do these companies make it through? Is it truly survival of the fittest and strongest and biggest? Or do some of these, what do you think, Tony? Do these small and mid-level companies make it through? And if so, how?
Yeah, I think one of the things that is benefiting everybody in this particular cycle is the fact that we just came off of one of the best couple of years in the mortgage industry. But the question is how much of that kind of once in a lifetime, money that everyone made, how much of that do you want to put back into your business to make it through this? And then once we get through this, what's even on the other side? Does the industry ever look the same? And I definitely want to talk a little bit about that before we wrap up this conversation. But no, I think that, and it's not just small companies, because, I did run an independent mortgage company. We were a small company and we made it through the crash and, in 08, 9, things were good in 10, 11, 12, 2013 came, things got really tough again. And one of the things that I remember bumping up against was there is a lot of covenants and restrictions that you have on your warehouse lines, with your other, just any counterparties that you have relationships with. You have, net worth requirements. You have, and you have them with Fannie and Freddie too, right? So you have net worth requirements, you have liquidity requirements, and you have covenants and restrictions on your warehouse lines that have nothing to do with your net worth and really have a focus more on, are you running a profitable business? And so I know that during times like this, warehouse companies will give you, look, if everyone in the industry is losing $1,000 a loan, to your point, then obviously no one's making any money. So the warehouse lenders can't just shut everybody off at once. They will give you kind of a holiday, if you will, on those covenants, and they will let you breach covenant. It's not the end of the world. It's not like, hey, you're in breach, so you're shut off, but it's like, hey, you're in breach, so what are you doing about that? Or what are the compensating factors that your organization has to where we should feel like you're still a good counterparty for us, even though you're, in breach of our agreement in some other form or fashion. And obviously having huge stockpiles of cash would be a huge compensating factor to allow you to run that way. But at some point, Ryan, I don't care how big or small you are, you have to be running at a profit or have a plan on how you're going to return your organization to profitability. And when you don't have that servicing revenue to say, look, we actually are profitable, even though we're losing money on every loan we originate, that is overshadowed by the servicing revenue that we have coming in because the size of our portfolio. So therefore, we're in good shape. Now, a lot of companies during COVID did service all their loans, and then they've sold some of that servicing. So they do have huge stockpiles of cash, and I'm sure that is working for them as they navigate through this with their warehouse lenders. But for how long? How long is that runway? And I think we're getting close to the point where even if the warehouse lender loves you and they want to continue to do business with you, they have regulators too. They have boards. They have other chief risk officers who are looking at the counterparties of that warehouse bank saying, we can't have this many of the mortgage companies that we lend money to in breach of contract without a game plan. We need to do something about that. And I haven't heard of anyone like losing their warehouse lines, but there's a lot of whispers out there about the fact that people are on the brink of potentially having to deal with that. And I don't know what there isn't a good answer. I mean, for us, it led to selling the company and going through an M&A activity. And I think that might be where it leads here for a lot more mortgage companies. Some because they have to, and others because they're just going to realize that I don't want to continue to feed the beast. I don't want to continue to give back all of this life-changing money that I made. We fought a good fight, but you can sell your company right now and get a good return. You can negotiate an earn-out, and you can become part of a larger organization. Not everyone's going to go that route. Not everyone should, but I do suspect that we start seeing more of that. Now that we can see the dot plot, we can see that this is likely going to continue into the middle of next year at a minimum. I do think, obviously, you mentioned the war and the attack on Israel, which is just unbelievable. I couldn't even believe it when I read some of those articles, and my heart goes out to what's going on over there. But the reality is that it also is an X factor in what happens with the markets. I mean, as a result, the bond market, at least in the short run. So it'll be interesting to see, but I don't think that that's enough to change the trajectory that we're on. The Fed has made it very clear what their intentions are. And so I don't see geopolitical or, those sorts of situations drastically changing course. But then again, we didn't see COVID coming. So any sort of black swan event is possible. But I guess back to my point is that knowing that this is going to continue, I think that a lot of these companies have to be thinking about, does it make sense to partner up, sell the company, do something different given these challenges that the market presents?
You make a fair point too, but it's the pain is not preserved to just the small and then the medium-sized company. You and I were on a text thread earlier this week discussing a top 5, maybe even a top 7 IMB, talking to another top 5 IMB about an acquisition. So you're right. It can be the fact that you're big, but maybe you just didn't run the business well enough. Maybe to your point, you don't have a good enough plan to weather the storm. Like this is real. Like this, we saw a warehouse impact in 18 with margin compression. We saw it a little bit in 2020. We grabbed a group of people that about, Tony, and they were reminiscing about how they literally had to stagger fundings because of the warehouse covenants that were pulled back, not removed, but pulled back. So they're like, all right, we're gonna fund the Smith loan and the Jones loan today. And like they went through on a daily basis for a short amount of time, and they're kind of laughing about it. But that's entirely possible and what can happen. I've been saying all year, to stay in this business, owners have to have 2 things. It starts with capital. I already talked about why, so did you. If you have the capital, which most people don't, then you have to have the desire to spend the capital for an unknown amount of time to stay in this business. And then you talked about the third one, and I'm glad you did, because not very many people are. Even if you have the capital and the desire as the owner, did you convince your warehouse lines that you still have a good, profitable, sustainable business? Because they may feel differently, and they turn off that switch or they limit that switch, and it's a pretty quick runway to not closing loans anymore. So it'll be really, really interesting to see this Q4 shakeout. And it'll be a really interesting tug of war, because typically a war would lead to lower rates, ironically enough. But we've still printed a lot of money. There's a reason why the Feds say higher rates for longer, because they have to pay for it somehow, selling treasuries for higher. So usually war would equal lower rates right out of the gate. As weird as that sounds, if you're a consumer watching, it just does, and we don't need to unpack that. But because of everything we just paid for in the last 2-3 years, it may not have the impact that we're all hoping for. Especially, we're 24 months into this contraction, by the way, guys. If you go back to like MBS charts and find the first time where we started stepping down, if it feels like you've gotten your ass kicked, it's because you have, and it's been 2 years of it right now to the day. We'll see. I don't think it's going to have the impact that we're hoping for. It might be a little bit of hopium for all of us that have been beat down in the industry. But there will be. I do believe that there is going to be a really good run, a really good run on the backside of this. Again, I don't know if it's going to look exactly like it did from 2008 to 2022, because that was the season of prosperity after some adversity. But this too shall pass. I love that saying. It's overused, but You think, you think back, remember when we were in 2020 and how good we felt about ourselves. We figured it all out. We're making a ton of money. Hold on, young fella, this too shall pass. Like, that prosperity will pass. Also on this side, guys, you got your ass kicked and you're hating life, you're hating the business. This too shall pass, right? And so we'll get back to some sort of normalized rate market. Will it be like 2020? Probably not, but it won't be like this. I promise you that. And it'll be a good time to be in the business.
It's not just warehouse lenders. When I was running that independent mortgage company, I actually had more pressure from my correspondent lenders than I did from the warehouse lenders during these skinny times. And to the point where, Wells Fargo is no longer in correspondent lending whatsoever, but it got to the point where they wanted to see weekly cash flow projections. They would do monthly audits of our ATNW, and they had which is the net worth, right? The tangible net worth of your organization. And they have their own calculation. So you can work with your CPA and your accountant and you can say, hey, this is our net worth. Well, they don't agree with the math and they have their own calculation. And so there's other things besides just warehouse lenders. Warehouse lenders are the first thing that comes to mind, because without your warehouse money, none of us are lending our own money unless you're a bank. But there is other relationships that can really put you in a pinch. And I just have to imagine that those are happening. Here's what I will tell you though, is you can do this on a if you are an owner that's just really committed, you would be surprised what you can go through. If you've been in business for 10 years, 20 years, you're not just going to let your company go out of business, and you can fight and you can make it through. But I got to imagine a lot of people that have been fighting for a long time thinking this would turn have to be at a place where, they might not have the fight left in them or the abilities. So you guys, with that, Ryan, look, we're going to have you back at some point because I love these conversations. And, I just think that it's important for these sort of things to be talked about. And I hope that those of you in our audience enjoyed this conversation. I hope that you like and subscribe to the Market Shares podcast. And like I share every week, it's not so much that I'm trying to gain subscribers. I really don't necessarily care about that. But what I would really appreciate is telling someone else in the industry about Market Shares, to check it out, to watch what's going on. If you know loan officers out there, or if you manage loan officers, encourage them to watch the RE Source every Monday. Encourage them to watch shows like Market Shares, where we talk about sales strategies and what's going on in our industry, because this is how Ryan and I got ourselves educated about this industry, was by participating and caring, about what's going on. And there's going to be a lot happen in our industry over the next months and years. And you want to be tuned into the resource.tv. You want to watch shows like Market Shares and be relevant and care about what's going on in our industry. So with that, you guys, thank you so much for your time. Mr. Hills, thank you so much for being here, and we'll catch you on the next episode. Take care.
Appreciate you, man. See ya.